I'm Nick Hughes, and this is Founders Live Conversations. So welcome to Founders Live Conversations. I am Nick Hughes. I am the CEO and founder of Founders Live, and really excited today to really just talk about innovation, talk about areas to look, especially in the United States. Is there ways to not only innovate, but actually save a lot of money with some of the tax credits that are out there. We have a special guest from Leyton, and this is Guillaume, and I might have not pronounced that correctly, but I will have him introduce himself, give us a little background on himself and Leyton, and then we'll jump into our conversation. So welcome.
Thank you, Nick. Yeah. I go by Guy internally as my company, just because people kind of gave up on Guillaume. Just the 9 letters and all the
stuff.
The vowels just kind of throws everyone for a loop. So I've just succumbed to Guy now. But yeah, to your point earlier, actually, just talking about everything going on, I think one of the things that's really been highlighted is just like the adaptability of us as a people. Certain sectors certainly got, pretty hammered, manufacturing involved, but I think just the adaptability and way everyone was kind of able to pivot to, conducting business entirely online. It's been a pretty seamless kind of transition, in some ways more than others for businesses. So I think that's really highlighted just like adaptability of us as, people and conducting business. But I am here to talk about a government incentive. It is tax related. And I know that's not necessarily the most exciting topic, but it's tax related in the sense of getting money back from the government. So maybe that appeals a little bit more to people. Should I go ahead? I have like a 10-minute little slide thing to kind of educate real quick on what this research and development tax credit is and how it actually apply and benefit to small emerging companies. I think it speaks, aligns very well with, the community and the messaging that Founders Live is, trying to convey. So,
Yeah, let's do that. Let's definitely, have you walk through, and that'll be nice, with your slides to be able to both really introduce us to Leyton and then, really talk about what is available. And then what we'll do is we'll have more or less me and you will go through a couple questions that I have on the high level of interest. And then what I would like to say is with everyone, feel free to take note of your conversations. This is a group conversation. We can ask really anything, but what we want to do is have a little bit of discussion that allows you to think about some of your questions, and then we'll open it up for Q&A. So go ahead.
Absolutely. So I don't know. I'm just going to hit share screen here, but disabled by participant. So I think you got to enable me to share screen here.
All right. Let's see. I'm just going
to. Oh, okay.
You should be able to do it now. Is that correct?
Yep. So let me know if you can see that. Yep. Awesome. So I'm going to talk about real quick, keep it to 10 minutes, the R&D, the research and development tax credit, particularly how it can benefit startup businesses. So just going to touch on what it is, talk about what kind of companies are eligible, talk about what actually is R&D. You'll be even more interested, I guess, in that after you see the gamut of the industries and companies that are eligible for this tax credit, what can be claimed, and how do you actually go about claiming it. So what is the R&D tax credit? It's a federal and state federal and state tax incentive that's actually been around since the 80s as a method of just rewarding American ingenuity, incentivizing innovation, development, keeping jobs on US soil. The idea being, if we incentivize companies with this tax credit to innovate, develop, they're going to grow. As a result of them growing down the road, they're going to end up paying us, the government, more taxes. So companies get a credit, they're happy. The government is incentivizing the economy, stimulating the economy, keeping US jobs. Everyone's happy. Except for about 25 years, it was only really taken advantage of by big pharmaceutical companies who you typically think of when you think of R&D. You think of scientists and lab coats mixing up, petri dishes, coming up with a cure for coronavirus. But as you'll see on the next slide, the scope of what is and is not eligible, or of what is eligible, is so broad, so extensive, that it's actually massively underclaimed all across the board. And it was also partially not really claimed up until recently, that being 2015, because it was on a 2-year renewal contract from 1980 to 2015. So most companies, it wasn't even really worth it to consider. But in 2015, Congress introduced this thing called the PATH Act. It gets protecting Americans against tax hikes. But what that really did is it made the credit permanent. I'll touch on why that's important later. But it also expanded the amount of qualifying activities greatly and essentially made it way more business friendly and allowed it to kind of apply to practically every industry in the country. So this is a pretty heavy slide here, just tons of industries and sectors to give you an idea of the just vast variety of different people or companies that can claim on this. So you see, it's kind of more obvious in a way that manufacturing qualifies, or developing and creating products, but it covers engineering, people doing consulting, and then your software engineering companies, your software developers creating AI platforms. That's a big one now. There's startups left and right emerging that are doing some kind of software innovation. And then the sciences, I think, are really just a unique one here that highlights just how wide of a variety of companies can claim this credit. Dental. In the last month alone, we've brought on over 100 dentists who are, believe it or not, creating or improving a product. If you think about a crown that goes into your mouth, that is a unique product. It's customized and it's being improved upon. So that's actually a way that you can qualify a company for the R&D tax credit. And then construction is another big area where I'll have a conversation with someone and they say, look, there's no way we do R&D. We build the same thing every time. And I say, well, are you building on the same plot of land? Is the same and following the exact same route every time? And they say, well, no, I guess, each plot of land is different. And so just by that nature, it's a unique project and can be qualified for R&D. I think as a result, just largely attached to the stigma that R&D is science-based or tech-based, a lot of companies are just underclaiming it as a result and missing out on this credit. So what actually, I said everyone qualifies. Well, how do you qualify? What does it take to be a qualified research activity, right? And really the one piece that's worth just focusing on, you can kind of ignore the rest, is, are you developing or improving any product, a process, a technique, a formula, a batch of code? Any improvements that you're making to you as a business, it doesn't need to be new to the industry. It doesn't need to be new to the world. If it's new to you as a business and you're improving on something, it's more likely than not has some elements that are attached and eligible to claim for this R&D credit. But really the 4-part test is what the IRS uses to determine something as a qualified activity. Are you improving or developing something? Is it technical in nature, relying on mechanical engineering, computer engineering, the hard science, any of the hard sciences, physics, et cetera, et cetera. And then the last two, experimentation and uncertainty, they kind of tie hand in hand in that, is there an element of uncertainty in the end result? And are you actively taking steps to eliminate that uncertainty? When you're going out to improve something, you don't necessarily know the end result. And that kind of ties into the experimentation, because there could be, some trial and error involved where there's option A and option B. Boom, you qualify. So how do we actually calculate this credit? We'll typically look across 4 big buckets. We'll look across W-2s, or salaries of any technical employees, engineers, developers, even sales folks in software companies who are working with customers, and the sales rep is gathering, feedback from the client based on the software they're using, and the software rep relays that, the sales rep relays that to the development team. You can actually capture some of those costs. It's not just the engineers or the developers, it's management is overseeing those developers, you can claim some of their costs. So look across W-2s, 1099s. I know a lot of startups don't actually have, W-2s yet. A lot of them are just, putting all the money back in the business. They don't pay themselves a salary. And so whatever, that's not important, but you got to pay someone to develop this stuff. And so, 1099s and subcontracted work, outsourced development is a big piece too. There is a caveat in that you can only claim up to 65% of those costs, but we don't need to get, that in depth at this point. So we'll look at 1099, any outsourced development, as long as it is US based. There's a loophole, because there's always loopholes to taxes, in that if the money flows through the US to developers in India or Poland or anywhere overseas, you can still kind of claim on those costs. Raw material supplies, anything that's consumed in developing or creating a new product process. And then computer licensing or leasing costs, like AWS, Microsoft Azure, that's used for a production or development instance. Or like if you're a construction company or designing a product, if you're using CAD modeling software, things like that. And then if you're applying for patents and you need to pay attorneys, you can claim on those costs too. So we'll basically pool together all those costs, and then that's kind of, you take the sum of those qualified costs and take about 10% of that, and that's about the credit that a company could receive. So if you have, keep it small. If you have one person paid that's doing qualified stuff, they're paying $100K, your company for that 1 year would be eligible for around a $10K tax credit. And it's not a deduction. People often, I'm getting a little too in depth here, but it's a tax credit. So it is a dollar for dollar credit. People often say, oh no, we already write off R&D, but that's separate from writing off R&D as a deduction. You can essentially double dip, for lack of a better word. So maybe could have put this up front, but what is the R&D tax credit? What does it actually do? We know all this stuff, but who cares? What does it do? I'll touch on the federal and in-state R&D tax credit first. What that does is it offsets a company's income tax liability. The IRS allows you to look back up to 3 years. And if you haven't claimed this credit before, you can look back up to 3 years, claim on activity from those years. And if you paid income tax in those years, the IRS would issue a cash refund. If not, you can still claim the credit and essentially bank them and carry them forward for up to 20 years. That's great and all, but part of why this was so underclaimed and not really used by anyone is there's all these startups investing so heavily in developing a product and just startup costs. I don't know what you want to call it, but they're operating at a loss and they're like, well, great, I'm doing all this development, but I can't benefit from this credit. That sucks. So in 2015, in this PATH Act, they also added the payroll tax credit. And what that does is it's introduced specifically to benefit startups that are trying to get off the ground. And instead of offsetting income tax, it offsets the employer portion of your FICA tax liability. If you don't have any W-2s, you still would want to consider claiming it. And I'll touch on it why in the next slide, because it can be carried forward indefinitely, but there's an additional set of rules for the payroll credit where companies can only claim it in a 5-year window. So I think that covers kind of what it does. The payroll tax credit is hugely beneficial for startups. It was introduced for startups. And this is why, right? So to be eligible for this payroll credit, there's an additional set of criteria, those being the company has to be under $5 million in gross receipts and has to be founded within the last 5 years. So there's ongoing legislation to increase that number to $10 million, and I think to increase the eligible year window to 8 years, but that's in legislation, and that could be anywhere from 6 months to 2 years down the pipe. And if you're spending a ludicrous amount of money in development costs, it is capped at $250K, but they're also looking at increasing that. And it can be claimed year over year for that 5-year window. So even if your company is pre-revenue and you don't have W-2s, but you're spending all this money in R&D, you can only claim that payroll credit within that 5-year window. So it might be beneficial to you to claim the credit early because the payroll credit can actually be carried forward indefinitely. So I might be getting too in depth and throwing out a lot of confusion here, but I'm just going to wrap it up quick, right? And so I said in 2015, they made the credit permanent. And why is that important? Well, it's an asset on the books. It's something that companies can include into their financial planning and analysis on a year-over-year basis. It's something that's not going anywhere, and you can rely on this credit. And as soon as you have a better understanding of the credit, what kind of activities and what kind of projects, and when you sign a contract with someone, how to phrase that contract so that you can benefit instead of the person you're signing to do the work for you. It just allows you to really have a firm grasp on your numbers as you're scaling your business. This isn't a pitch, necessarily on Leyton. I like to keep it really educational first, but the perks of, partnering with someone is that you get an ongoing consultant. So as you're signing on contractors, the reason I'm bringing that up, I don't know if it's, something people want to understand more about, but when you sign a contractual agreement, if you're paying someone to develop a product for you on a time and material basis, the risk is actually on you, because if it takes them more time, less time, I'm going to incur the cost. But if you pay them on a fixed fee basis, guess what? That person's at risk financially. And so they're actually going to be able to claim on that development cost. So having someone to help you, structure and figure out how to word those contracts, even, that's a valuable asset. But also, anyway, I'll leave that for later. But I think with that, really, I covered it. I think the kind of core message to deliver is, if you're doing anything new to you as a business, it's worth looking into.
Awesome. This is really interesting. Really interesting. What I'm wondering is if you could share, I think you're the one that's the host. So if you could share back the hosts, there might be even people waiting in the guests or like in the wait room, but if you could share back me the control for the meeting, can you do that real quick? Do you see that where you can do that? Awesome. Thank you. All right. Yes, thank you so much. That was great. What I would like to do is just start a group conversation, and this can be as detailed about Leyton or as detailed about the R&D tax credit, or as loose as just talking about ideas around innovation. So I want to structure it that way with the group. But my first question is really around, funding. How does funding, either angel versus VC, even like private equity, how does that affect this? And how should, let's start there, because I have another question around how startups can view this, but let's just start there. How does funding come into play here?
So funding is great because it means you have money to spend, but funding, whether it's angel, VC, is just recognized as a source of income. The R&D credit is totally agnostic of income. It's about how you use and spend that funding. So if you spend that funding to buy a nice car, well, guess what? That's not going to qualify. But if you spend it to hire an engineer or to do any kind of qualified activity, you're going to be able to benefit from the money you got from the funding and spent on research activity. So it's agnostic of, the revenue or the income that a company is making. It's just about how the money is being spent.
Got it. And, how would this influence a startup or, early stage team that is approaching, even just maybe they're just starting to create their company, they're just starting to build out either hardware, if not software, and then they're going to look to actually hire a team and develop a product. How would this influence a startup starting out?
So knowing, I guess, how the credit will be able to impact them as soon as they bring on that team, I think will be the valuable asset to that. Knowing that, okay, if we bring on 2 reps, we pay them $100K each and they're W-2s. They don't have to be developers. So if you already have a developer, so it offsets. So when it offsets FICA tax, we use the developer, we use the technical people's salaries to calculate the credit. But when it actually goes into effect, it affects company-wide FICA tax. So you could know that, hiring these 2 people is going to increase my FICA tax by, it's 6.2%. So if they're each paid $100K, by $12,000, I'm going to, see this increase, but I know that I'm going to be eligible for this amount in credit. So it's going to be negligible. I don't know if I fully understood the question. Does that kind of?
Yeah. I think, I think the thought here is, as founders and teams really start to approach growing and building what they want to build and hiring, and building their team, to more think about this up front might be a smart thing. So that's why I wanted to suggest that. We have some questions, and definitely a great question. It was going to be mine. That was I'm sorry. I don't know if you guys are hearing the echo. I'm hearing an echo, which is really difficult to talk. But anyway, so my question, or the question actually from Aga, who's over in Poland, is this just for US companies, or what companies or what areas of the world this can be applied to? I know that you have more of a global reach, especially for Leyton. So what areas of the world, and then how would that affect if a startup is not in the United States and they're actually in another country?
That's a great question, and remind me that I wanted to add something to your prior question after. But as far as it being available only to the US, no. So it varies country by country. Different countries have different forms of the R&D tax credit. But I know we have offices in the US, Belgium, Canada has a really solid R&D tax credit, Spain, Italy, Poland, the UK, Netherlands, Morocco. Basically, the answer to your question is that these innovation or incentive, or call them innovation incentives, tax incentives, exist globally, but they're different country by country. And so working with, someone who has a local presence and understands those credits, because the code is different by country. So for in the UK, for example, it needs to be something that's new and novel kind of to the industry. Whereas here in the US, it's just as long as it's new to the business itself. And then to touch on your point earlier about how, what's the, value in knowing about this credit before you actually get involved in something. I had a call 2 days ago with a client, and unfortunately they didn't qualify, but they partnered with us in that, and the value that's going to be added there is that, well, first off, they're not going to have to pay anything. But second off, they're scaling. It's a construction company. They're going to be adding complexity. They're going to be doing bigger and more challenging projects. And so they'll be able to kind of bounce ideas off of us as they get, contractually obliged and take on these projects as to, hey, I'm about to do this. How's this going to impact me financially?
Got it. So we have another question, and this is really around the double dip comment that you made. And, I think that, it's funny, once those words are used, maybe it's like, oh, really? What does that mean? So could there be a little bit more elaboration on what does that mean when you say that companies can essentially double dip on their R&D because I would assume that there's, or even like the payroll, you might've mentioned that, where there's there's a tax incentive over here, but they can also take advantage of this one. So just describe that a little more.
Yeah. So I try to be cautious. I use the word double dip, but I don't like to because that's opening just like a can of worms for me personally. I don't know too much about the legislation. I just know from told by so I've got a team of way smarter people behind me. Well, not behind me, but, in their own virtual offices who are tax attorneys and tax consultants. But what I meant by double dip is that you can write off R&D as a deduction. It's just separate. People think, oh, I'm already writing it off as a deduction. They assume they're one and the same, but it's just, it's different. They're calculated different. It applies to different things. It might be referring to writing off like capital expenses, like equipment used for R&D. So I guess the whole point of that is it's still worth a look. Even if you think you're already claiming it or writing it off, just because it has the word R&D, people are like, no, I already do this, but they might be thinking of something other than the tax credit, I think is the kind of message I'm trying to deliver there.
Got it. And that would probably be the best idea to work with your own accountants. And how do you suggest early stage companies, not only take advantage of this, but also they should pull in, how would they pull in their accountants to help them maybe understand this as well?
So you can see Leyton as like an extension to a CPA or an accounting firm. I think, to give an example, it's kind of cheesy, but you never, hire your general practitioner to do open heart surgery on you. So whereas a general CPA or accounting firm can offer up to 52 different services, they cover 9,000 pages of tax code. We're a specialist and we focus on one tax credit, 500 pages of tax code. And so because of that, it's a pretty complex process on the back end as far as calculating it, justifying it, supporting it. So CPAs will often just partner with someone like Leyton or another R&D tax credit specialist to just outsource this R&D study because of the kind of depth and just the process of having to go about actually claiming it. They'd rather just outsource it. So we partner with CPAs to do the R&D credits for their clients. So we work closely with them. I was going to say something else, but it escaped my mind. So I'll bring it up when it pops back up.
Yeah, for sure. So to kind of jump back to in terms of location, in the chat, I had placed not only Leyton's homepage, but also they actually have a page around for their offices, and you can see at least even just the range around the world of if they have offices, that pretty much means that they're going to be servicing that country. So what would we expect over the next couple of years? If you have insight on that, what would we expect? Is there going to be more countries that are involved here as the reach continues to grow? Do you have any insight on that?
Yeah, so we're adding offices continuously. I think we most recently opened an office in Germany. But as far as the R&D tax credit, is concerned, it's strictly beneficial to whatever economy is supporting it. Because the whole premise, right, is we're stimulating and incentivizing development, which is down the road going to lead to companies selling more, growing more, and paying more taxes to Uncle Sam or whatever tax uncle they have in their representative country.
Got it.
Yeah.
Okay, so we have another question. Are there any other innovation-related tax credits you see startup companies miss? So is this just the only one, or is there other areas that you see that that we should be aware of?
Yes, and we cover some of them, but we don't. So it's, for example, in construction, I think if companies are leveraging green technology or trying to reduce their carbon footprints, there's plenty of tax incentives tied to that as well. That's the main one I know off the top of my head is like doing, it's called LEED certified buildings. I forget what LEED certified stands for, but it basically means green friendly and yeah, I don't know a ton of other, innovation incentives aside from the R&D tax credit.
And would, if a startup wanted to do more research to find these possible tax credits, would they start at Leyton, or is it maybe just a Google search? If there are others out there, such as the LEED, energy one, what direction would you suggest that they start to research this area?
I mean, Google's a great research, but obviously just speaking to someone who does tax stuff on a day in and day out basis, specifically around innovation incentives. My job focuses specifically on the R&D tax credit, but I know our tax attorneys went to school for this stuff. So that's usually how a conversation with Leyton starts, is we bring together this team, we'll talk through some of the things they're doing, and maybe they actually don't qualify for this R&D tax credit, but maybe something gets brought up in the conversation that one of my smarter people picks up on and says, oh, well, have you looked into this, this, and this?
Yeah. Thinking about the current status of the world, and I think just for transparency with everyone on this call, me and you started talking later last year, and the world was a different place and in a different place at that time. And so given that there's a downturn, given that there's a lot of other things going on in the world now, does this affect the way a startup should view this, or is it simply like, hey, in the good times and the bad times, you should still look at the innovation tax credits?
Yeah, and that's a great point. One of the very, very last things I want to ever do is, turn a negative into a business opportunity. But in reality, the tax credit is solely to benefit companies. There's no I gotchas or anything like that. People think like, oh, by claiming the tax credit, am I going to increase my risk for audit? And my response to them is, well, you may as well just not file your taxes. It's just a form that you include, like any other form you include on your taxes, so that your risk of audit is the same as if you're just filing a normal tax return. And then, jog my memory again onto the actual question.
Well, in terms of timing, is it, in a downturn versus
yes.
Great times? Yeah.
Right. And so I know with the whole CARES Act and the people have been talking about, I think there's been the option introduced to just defer any payroll taxes until 2021. And, my response to that is, by deferring, you're just pushing a problem today to a problem down the road. You're not wiping anything out. Whereas if you actually leverage the payroll tax credit, you are completely deleting, the problem instead of just pushing it down the road.
That's a good point.
And then the traditional, tax credit, cash is king right now. So if you have paid income tax in any of the past 3 years and you did qualify for the credit, you claim the credit from those prior years and you get a nice little check from the IRS.
Nice.
And spend it how you want, whether that's to hire another employee or fund that next project that you were thinking about that you needed for. So it's really just about giving cash back to money or to companies.
Yeah.
Already.
So, okay. Anyone, of the group, please, again, submit questions, or, we're kind of getting to the later part of the hour. If you do want to just kind of unmute and throw some comments out or questions, feel free. I know we have, I'm going to call some people out here. We got Melissa, who's down in actually Phoenix, you're in the Phoenix area. Melissa, you're innovating around the health and benefits space. Do you have any specific questions, thoughts, or how this might, even benefit, your organization?
That's what I was trying to figure out, if there is some synergy and if this is something that is applicable to my space. Because I'm not really innovating a new product. So it's more of a marketplace. I don't know. Could it fall under? Could it be appropriate? Could I get a tax credit?
Oh, go ahead, Nick.
Yeah, just to give a little more context, she is creating almost, you could consider it as a marketplace, but it's a layer on top of health benefits, actually, for freelancers and smaller companies that don't necessarily qualify for traditional health benefits, and it's cost effective and cheaper. So it's a kind of a layer on top of what's existing around the health benefits in the United States. I would consider it innovation, but she's not really having it's less of a traditional R&D play. So this is a good example of an early stage company that is probably, is it a gray area to utilize this incentive?
I'd say the kind of question to ask yourself is, are you employing anybody to do any kind of, is it a software platform?
Not, I mean, it's on a platform, but it's not, no, not yet. We will be using some AI. So that's definitely, I think in the future will be for sure, that's the innovation there. But right now it's pretty black and white. Yeah.
I mean, I think the first question to kind of ask is, are you leveraging any technical to do your work? Whether that's engineers is a great title, but developers, and whether they're full employees, or whether you outsource people to design or develop something. If you're
so outsource. So I did outsource. I mean, they're not full time, right? So and it is a development company.
Mm-hmm.
So is that part of it then?
Okay. Absolutely. Yeah. So
good to know then. Yeah.
Yep. So I mean, we speak to like app developers and stuff, and they outsource a majority of their production, right? And so outsource costs. Just the question of, are you doing anything or employing anyone who does some kind of technical work, whether that's computer related or science related or anything, sciencey related?
No, that's great. So the answer is yes. So that's really good to know. Thank you. Thanks, Nick.
Yeah. Good question. And, I think the lesson here is really, it's worth the evaluation and even just the research initially. And, what's the worst, I guess my question would be, what's the worst can happen? And then maybe as a loaded question, but quite frankly, if a startup is looking at it, they can at least dive in, do some research, and see if this is something that they qualify for.
Yeah, I mean, it is kind of cheesy, but it's so true. It's a dollar for dollar tax credit. We're not talking about deducting your taxable income by a couple hundred or a couple $1,000s. This is serious cash, and it's taking 30 minutes of your time to actually confirm that you do or do not qualify, and having that peace of mind, or potentially finding out and then bam, you just found some extra cash flow for your company. So it's 30 minutes to do, I guess, due diligence, and rule anything and everything out as far as a tax perspective goes.
Yeah, interesting. Allison, I know that you're more in the kind of talent and recruiting space, but how do you see this applying to maybe the companies that you work with or talk to?
So I already knew about this, but I am thinking about starting like a software solution company. So it's really useful. I already kind of did. I actually spoke to somebody from Leyton. I can't remember.
Oh, nice.
But I did. I don't even remember why I was talking to them. But I did. Must have been at some event. Somebody showed up, so I did learn about it. Really interesting. I do try and tell people about it. I don't really kind of go into details. I'm like, hey, you could do this. And I did know it was pretty broad. It's like basically if you're innovating or you're doing anything new, you basically claim it. So I'll definitely send them to Leyton though. When people ask about it, so send them to Google. But yeah, I think it's really good. I like it.
Awesome.
Nice. Aga is over there in Poland, and she was the one that asked about, like where else in this world can we maybe take advantage of this? Aga, what are your thoughts over there? And were you aware of this? Oh, she's having some problems with her mic, so no worries. It's just good to have you listening in general. But yeah, she's over there in Poland, and I know that she's interested in this, and she's working on some things as well. So it's probably a good, it's good. If someone is in another country, I know that you have other offices. What would you suggest they do? Just go to the website and kind of inquire there, or is there like you in all these other areas of the world?
Absolutely. Yeah, I was going to say that. I mean, if you're located in another country and interested in seeing if it applies, I would love if you shot me a note first so that I could make the introduction and selfishly get some credit for making an introduction. But yeah, you could absolutely just go to our website too, and request, for a follow-up that way.
Nice. And then, Sun, you're up in, I believe, Canada, if I remember correctly, and in Toronto. So what are your thoughts here? And, sounds like you guys, Leyton's up there, and there's an ability for that too. But Sun, how's it going?
Fine. Thank you for your great presentation.
Thank you.
I enjoyed very much. I'm new actually, and I try to learn everything about starting a startup and increase my knowledge actually. The only thing that I can maybe ask is, you mentioned that's a permanent from the government is tax credit. What do you mean? So after.
So so in the U.S., they, in 2015 via the PATH Act, they voted to make it a permanent tax credit. So up until from 1980 to 2015, it was on a 2-year renewal as far as, so every 2 years they voted on whether they're going to keep this tax credit available to companies to claim. And so there was a lot of uncertainty about it, and companies just didn't want to dedicate resources to figuring out how to go about claiming the credit. So in 2015, they said, this is great. It only benefits the economy. So let's just make this a thing that companies can, count on, know they'll be able to claim year over year. There's no cap to the R&D, the traditional R&D tax credit, the one that offsets income tax. So it's not going anywhere.
Mm-hmm. And it's maximum 10%, as you mentioned, or
So
different?
That's the best way to guesstimate, but it's federal and state credit. So, and it's also, I don't want to get too technical, but it's actually calculated based on increasing research. So if your R&D expenditure is flat year over year, it may only be, 9% that you get back from your qualified expenses. But if you show, a really steep increase in your R&D expenditure year over year, you may be looking more at like 12 to 13% return. So you also have to factor in the state credit that it varies state by state. So some states don't have any, some states match the 100% of what the federal credit is, but unless you want to go about trying to figure it out yourself, generally the safest way to kind of come up with an estimate is around 10% of your total. So you pull together your costs, take about 10%, and that's the credit you could get.
And before starting, could I, for example, do the evaluation? For example, we want to start a startup. And for example, for patent, you said that we can apply and or for other, before starting, I mean, is any way to predict how much we can calculate on this budget? Yeah.
So, I mean, like I said, I had a conversation with someone, and we found they don't currently stand to benefit anything, but they still are, partnered with us, and they're going to revisit it down the road, but they'll be able to leverage us as a consultant, and just have conversations with our team about, hey, here's, the patent I'm about to apply for. I'm looking at this much in costs. What is my return going to be like, if I do X, Y, and Z activities? We certainly, I mean, we're a consulting firm, so we act as a resource, and it's not like we charge $300 a minute or an hour or whatever it is. We are, our model is to be strictly contingent. Our model is such that it's solely contingent on what we identify for you. So like I said, if we identify today there's nothing, well, then you owe nothing. So eventually, as you take on projects and it does become a real thing for you, then we would ask for a little bit in return.
Great. Thank you.
Yeah.
Right.
The Canadian credit's pretty solid too, I think. So if you wanted me to connect you to the team in Canada, I'd be happy to.
Thank you so much.
Well, thank you so much. Yeah, this has been great. This has been very, very informative. And I would encourage any startup to just simply look at this, simply put this on the list of the things to do as you're going about, as you grow your company, and obviously with, filing taxes and all the things that are a part of that as you work with your accounting team. Definitely put this on the list, and you have resources now. So thank you so much. And Guillaume, I thank you, man. I just so you know, I will actually be in Boston. Let's see, the kind of later part of the summer. So I'll let you know, and hopefully there's a time that I can be out and about in the city.
Yeah. The summer is about the only time it's really nice to come up to Boston. So you chose well, but yeah, absolutely. I would love to do that. And thank you all for, hearing me out on the exciting topic of taxes, but otherwise, thank you.
All right. Yeah. Thank you all so much for not only joining in here, if you're here live, but listening as well on the recording and watching on the recording.
So thank you.